Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? A little emotional, a little nervous, got the markets going a little bit crazy. Well, I think we're going to start expanding these FinTips series to kind of walk you guys through this. We're certainly expanding the emails that we send out to customers, the classes that we do for them. We want to walk them through all of this in great detail. You guys know I'm a bit of a data geek here, so we're including a lot of that. And I just kind of want to share some of this with you guys publicly, at least what I can. No doubt the markets are really wild right now, mostly to the downside, and so that creates a lot of emotion. There's really three things that drive the markets. It's emotion, it is strategy, and it is data, period. That's all that's happening. You got your quant traders trading on data, they have no emotion. Your retirees trading on strategy, they're emotional, and your emotion traders could be, your short-term traders, investors, or whatever. But today I'm talking to those of you that are over the age of 50. Because you know what's happening right now? I see it. I talk to customers every day. They're like, wait a minute, I just lived through this in 2008. I saw that 56% downturn in 2008. I'm not living that again because I'm closer to retirement. I can't do this. Well, before you get emotional, let's go through the data here. Let's talk about some of this. And I want you to also check out our video on Wednesday that we're doing this week about stress testing your portfolio, because I'm going to cover some other emotion in there as well. All right, here's the first thing I want you to do. You've got a pile of money. You've obviously worked very hard for it. You've seen it grow quite nicely over the last 9 years, and now it's starting to pull back. The first thing I want you to do is think of it in two categories. I know a lot of people use 3 buckets, 4 buckets, things like that. I'm not talking about that today. I'm talking about 2 different categories. Here's how this goes. See, what happens here is you are closer to retirement, right? Let's assume you are 55 now, right? You're closer to the age that you want to retire, maybe 65, 60, something like that. What we want to do is think about when we retire. I'm going to use 65 as our official retirement. Yay, we made it age here. When you hit the retirement age, what do you need? You need about 20% of your money to be rather cautious, right? It needs to be sort of safe, because in those first 4 to 5 years, right, this is the money that can't afford to take risk. There's no great data point that I can give you that shows you can take a lot of risk with that money and be fine. So what I want you to do is take, at 65, I want you to think of 20% of your money as not taking any risk. I am trying to combat inflation here. I am trying to maybe make a small yield on my money. I am not trying to do anything, extreme or excited about that. Why do I say that, right? What's the data behind that? How do we know how much risk we can take? Remember, I always tell you, ask as many questions as you can to the person that's managing your money or to your strategy, whatever you're doing there, because these are your dollars that we're talking about here. So here's why I say this. You want about 20% of your money safe because, and the best way to do this is just to illustrate this in a very crude kind of a graph here. What we're going to do is we're going to draw a stock market just moving along here. Everything's doing what it's doing. You see what's happening, right? And let's say that's the stock market in general. We've had a sloppy ride up there. We've hit a peak, and now of course, we're pulling back. It's not looking too good. Well, the average high to low point in a recession, not just the average high and low point in a stock market, but the average recession, right? Look back at all the recessions since World War II. We look and see what was the average decline. It's actually 458 days or 1.25 years from high to low. So that's what you're looking at there. And I want you to just think of that number there. So if we're watching the stock market go down now, it's been 31 days at this point. So we're way ahead of schedule in terms of how this goes. But 1.25 years. So what I want you to think of is with 20% of your money, I want you to think worst case scenario. The longest on record, we'll go through that, right? But so I want you to think in terms of average. You got 1.25 years from high to low. Now, that's 1.25 years. If 20% of if all your money is behaving in the same way, you got to sit through that. But now if you're retired, you've got to draw money out. What we want to avoid is drawing money out as the markets fall, because you're taking away from a dwindling value. We want to take away from an increasing value if at all possible here. So the average high to low, 1.25 years. Now, one thing that we can look at is how long to recover. The average high to high. Now, of course, you didn't invest at the high, but that's the full recovery, right? So if we were to invest fully aggressively and everything like that, what's the average time from high to high? It's actually 1,330 days. looking at all of the recessions out there. It's 3.6 years, if you want to write that on there as well. So 3.6 years. Because of that, we can't afford to be drawing from investments for 3.6 years. So we want to make sure that we have about 20% of our money, or 4 to 5 years, safe, right? Low volatility fund, for example. Our low volatility fund yields 2.53% at this moment, and its average growth rate is 4%. Slowest vehicle on the planet. We try to make it super, super slow for people that are either saving for the short term or are retirees that need to put about 20% of their money away in something really, really slow, all right? Again, the idea of this part of your money is just combat inflation, a little bit of yield there, safety, do better than a savings account, whatever it is, because you want to draw it out and pay the taxes if it's in an IRA or something like that. All right? So that's the first phase. 20% of your money looking like that. The other 80% of your money, which would be the second part here. So we broke your money into 2 categories. We've got 20% over here, right? And this is safe when you get to retirement. The other 80%, now we can talk. Now we've got something we can work with. And the reason why I point this out is because I don't know what you want to do with this, right? You could do whatever is best for you in your individual situation. But the reason I point this out is because so many people see a stock market fall and they make decisions based on their whole account. That may not be necessary. It may be that you have 5 years left to retire and you go, okay, well, I should be okay with the data that he gave me there, especially since we're falling faster than we've ever fallen here. But please don't make decisions with your entire account if you're in that 55, 60 category and you're a little concerned. The concern is totally normal, but we want to take your account and say, okay, well, realistically, this piece, this whole piece over here, I don't even need it when I retire, the year after I retire, 5 years after I retire, 6, 7, 8 years after retirement. I don't really need that money, and that could continue to grow, in which case I can survive this downturn, right? I can survive it with that piece of my money. Now with this piece of money, well, I need that, right? I can't afford to have a 7.5 year long recovery, which by the way is the longest on record, 73 to 74. It took us 7.5 years after that recession to recover. You can't afford to do that with all your money, right? You can afford to do it with a big chunk of it, and then that little piece over here, that 20%, you don't have to worry about it, because as we're recovering in that 75, 76, 1977 time period, your money's growing again. And if you run out of that 20% and you are retired, that's okay, because you're not rock bottom at the lows trying to take money out for retirement. So I want you to really think of your money that way, because everybody thinks, oh my gosh, the markets are falling, I need to make an emergency decision with all of my money. And then they also think that the money that they start taking out to live off of is somehow going to be taken out at the lows. It's not the case, right? So I want to try to help you guys eliminate some of the emotion. Because of that, I've gone a little long on these that we normally do here. I do appreciate you watching. If there's something we could highlight, some data point, I'm not able to answer to a lot of your comments. I do see them. But if there's something I can help you with to try to eliminate some of the stress, that's the focus I'm going to take here, because at the end of the day, the markets are going to do what they're going to do. Your strategy determines whether you get through it or make, hopefully, not a silly decision there. Anyways, I hope you enjoyed the video there. Thank you so much. Leave a comment below. Let me know where I can help. And of course, check us out at jazzwealth.com. We're always there. Happy to help. We manage long-term investments, of course, and we will talk to you soon. Enjoy the rest of your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.